We got more big news this morning for Intel stock investors as Bloomberg reported it could receive an investment of up to $5 billion from the private equity firm Apollo. These two companies have an existing relationship since Apollo invested in its Ireland manufacturing facility. Now, this comes after rumors surfaced that Qualcomm could be eyeing a takeover bid for Intel. Why all this sudden interest in Intel, right? And what does this mean for Intel stock investors? I'll discuss my thoughts on the developments in this video. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so here's the news that Intel stock popped in early trading Monday following a Bloomberg report of a potential multi-billion-dollar investment from Apollo Global Management. Intel stock is up 3.7% as of this recording on Monday. The private equity firm would invest up to $5 billion in Intel, and that management of Intel is considering the offer. And this comes after Qualcomm was interested in buying Intel outright. Now, that is highly unlikely, primarily because regulators and their opinions on a merger of this size, I don't think approval will be easy. And since approval won't be easy, I don't know if the two will make that merger unless they can find a third party, maybe Taiwan Semiconductor Manufacturing, to buy the manufacturing assets from Intel and then have Qualcomm acquire the other parts of Intel business. It would be a big, complex transaction. The likelihood, the probability is not that large, although it would cause a big shakeup in the industry to be sure. So why all the sudden interest in Intel stock? It's for a number of reasons. For one, the primary reason is the stock price, is the value of the business. So Intel's stock is down from $50 a share to start the year down to $22 per share now. So it's a beaten down stock. It's a beaten down company selling at a discount, and that's attracting investors looking to benefit from the discounted valuation. Intel has made tens of billions of dollars of investments in the growth of its business in research and development, and it has yet to receive the benefits from those investments. So it's in this sort of waiting period to reap the benefits from all the investments, and the price is beaten down as a result of that. And so investors are looking at Intel stock, trying to get a piece of it before they start to reap the benefits of those investments, which will boost the value of the business. And then it wouldn't be as attractive if it's selling at 2 or 3 times the current valuation. And just to highlight the magnitude of these investments, in the 6 months to start this fiscal year, Intel has generated $1 billion in cash flow from operations, while it spent over $11.6 billion in additions to its property, plant, and equipment. And it was a similar story in the first 6 months of last year, where it generated just $1 billion in cash flow from operations, but it spent over $13.3 billion in additions to property, plant, and equipment. So just in these 2 6-month periods, it spent nearly $25 billion in additions to property, plant, and equipment, while it only generated $2 billion in cash flow from operations. So those massive investments, those are long-term assets. They're not going to pay off in the near term, not in the next month or 3 months or 6 months. These are going to pay off in the next 3 years, 6 years, and 10 years. And so in that gap between the investments and the payoff, investors are circling Intel, trying to benefit from the loss of investor confidence in the company's success of this strategy. And so Intel has now become a riskier company because it's investing all this extra money on property, plant, and equipment in the foundry side of the business, especially where it's unproven to be successful. And it's competing against Taiwan Semiconductor Manufacturing and Samsung, which have already achieved massive economies of scale, and it's unsure, uncertain, or unlikely that Intel could reach those levels. You could see here total assets have soared up to $206 billion in the most recent updated period, and the company's debt has soared to over $48 billion. If I show you a longer-term trend of its asset growth, it's now have $206 billion in total assets, and that's up from around $90 billion in total assets in 2015. And so if you have a company with more assets, it's more riskier, especially if those assets are unproven assets. I talk about this in my book, my 6-step investing framework. And one of the things I consider in my investing framework is the capital intensity of a business. How much profit is it generating from assets? How much sales is it generating from assets? Is it an asset-light business model, or is it an asset-intensive business model? Intel is an asset-intensive business model. And so these business models are riskier than the asset-light business models. That's why you hear a lot of calls from investors asking Intel to divest its manufacturing business, sell it all off, and just become a designer and outsource the manufacturing to companies like Taiwan Semiconductor and Samsung, right? Focus on designing these chips and then outsource the manufacturing, because that can unload a lot of the risk and a lot of the assets and give it to someone else, and then you just deal with the design. That's what investors want Intel to do. However, Intel's going the other way. It's doubling down on the manufacturing, on the research and development, on bringing it all in-house, because it sees it as an opportune time to do that. The government in the US especially is giving Intel billions and billions of dollars in grants and low-cost loans to build out these manufacturing expansions, to build out its manufacturing capabilities. And so Intel management saw that as an opportunity to double down and invest at a time where it's getting subsidies from the US government. And so that's the big risk here with Intel is, are these investments going to pay off? Or is Intel putting tens of billions of dollars in these manufacturing investments that are not going to bring those returns that management is expecting? And you've seen the company now have to kind of scale back these investments. They announced that they're going to pause some of their manufacturing expansions to wait for the cash flow to start coming in from prior investments before they go ahead and expand the existing, because the balance sheet is getting stretched and management is noticing that investors are not happy with these decisions. The stock price is getting beaten down. And so they're scaling back and reacting to market conditions and their cash flow position to kind of slow down those investments. And that's why you see this potential investment from Apollo of $5 billion, because it'll help shore up the company's balance sheet, which has come under significant pressure in recent years following these investments. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock. And this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.